Did your student loan payments go up by 2 to 3 times? If you're not concerned about payments increasing when you renew your income-driven repayment paperwork, then skip this video. However, listen, recertification and your payments going up has nothing to do with what your actual income is as much as what proof of income you submit. So let's go over this a little. Why are people's payments going up? I'm going to talk about why people's payments are going up, especially in 2026. I'm going to talk about the change in the formula by the government, especially those leaving the SAVE student loan program to another income-driven repayment plan. And then lastly, I'm going to talk about the tips and tricks to reduce the amount your payment will increase year over year. Okay? So now let's get into the video. 91% of people viewing this video, though, are not subscribed. We know that from our analytics, so I ask you to subscribe. Comment if you're on the SAVE program. Put SAVE in the comments or ask your questions, and I will personally try to respond. So first and foremost, why are people's payments going up? It's because so many people certified into income-driven plans based on old income, like income from 2020, 2021, or even pre-pandemic. And now that people are getting kicked into repayment for the first time in many, many years, they either earned very little income when they certified originally, or they were partially in school and now they're fully employed and make 2 to 3 times more. So the reality is just using older income, people earned less, especially before the pandemic or during the pandemic. And then second of all, they're just using older proof of income for prior certification. And now they're trying to use 2025 income, recent pay stubs even, and you just earn more. So that's why payments are increasing. The second reason payments are increasing is because of formula changes on student loan plans. For example, a lot of people in the SAVE program enrolled because the payment reduction was so great. The formula was 225% of poverty was used for discretionary income, and that's subtracted from the adjusted gross income. And so if you're subtracting a higher amount of money because the government says the cost of living is higher, it costs more to live, we're going to subtract more and only make your payment based on a smaller sliver of your income. That's why people's payments are lower. Now that people are being required to roll off of SAVE soon, especially August 1, interest accumulates on people's paused payments on SAVE. This essentially means we encourage people, especially if they're public servants, to move out of SAVE. And the formula being 225% of poverty made people's student loan payments lower. Now, if people are moving into income-based repayment, now it's 50% of poverty. It's subtracting 150% of poverty instead of 225, which makes a sliver of income the government is relying on for payments to be higher. It's also using a higher percentage of that sliver. That's the formula. So automatically the way it's being calculated is changing, less generous, as well as people using older proof of income. That's the two main reasons. Now let's talk about, so we're seeing that a lot. People recertifying and freaking out because their payments are increasing by a significant amount, doubling, sometimes tripling, especially if people are married and filing jointly. So now let's break down what are the hacks and the pro tips to not have your payment increase that much. Tip number 1, try to gauge over the last 2 to 3 years what your annual income was. So let's say, here's an example. Let's say in 2023, you earned $65,000. In 2024, you earned $75,000. And now you're earning on pace to earn about $80,000. Well, logic would say you don't want to use this year's income, right? You don't technically want to use 2024 income either. You really want to use 2023 income. And can you do that? A lot of people immediately go and connect their taxes through the IRS pull on studentaid.gov, and that will use your 2024 income. However, there's been extended filings and a lot of people have not filed for 2024. So you can manually submit your 2023 income and they can use that. So that's tip number one. Try to use the oldest possible income that's allowable, and using 2023 income is totally allowable. Better yet, file into an income-driven plan when you are between jobs and have zero income. That's really the best time to file, because then you will legally get 12 months of $0 payments, especially if you're on pace to get loan forgiveness. That's a great strategy. So those are the two main tips that we here recommend at Loan Sense. We also help people file into the plans. We give you a full advising session. If you're going to get married, what do you do about filing jointly versus separately, along with what's the best proof of income to submit to make it so you're less likely to get to the 2 or 3 times payments. We'll go through all of that with you. But most importantly, we will submit your paperwork as well as your proof of income so that your payment doesn't increase by 2 to 3 times. We don't do it through studentaid.gov, and we do not recommend connecting your IRS tax returns, because that will mean even if you're between jobs, the loan servicer can go back and look at your last year's income as the latest proof of income. And we want to help people avoid that so they can strategize what proof of income to submit. So if that was all confusing, don't worry. We do have additional information through various videos, but we do also offer advising sessions and help. Click the link below, use code LS20OFF to get $20 off of our consult and filing services. We've helped hundreds and hundreds and hundreds of people for many, many years manage their income-driven and public service loan forgiveness paperwork and program to best understand their options for filing. So we can't wait to help you. Leave your comments if you have questions.